Hi there, in this video, we will review the economics of the firm behavior. In traditional economics, or say neoclassical economics, the firm's behavior is a black box. Someone puts input into this firm and gets output. Based on this scenario, the essential problem faced by a firm is to determine how many inputs and how many outputs should a firm produce to maximize its profit. We write the profit as equation 1. Pi equals TR minus TC, which means profit equals total revenue minus total cost. In neoclassic economics, the owner or the manager of a firm tries his best to maximize the firm's profit. Total revenue is related to market demand, and the total cost is related to the technology of production of the firm. Let's start with the technology side. We will discuss cost function, long run versus short run cost, sunk cost, and economic versus accounting cost. Managers monitor costs in income statement, Table P1, and the statement of cost of goods manufactured, Table P2. These pieces of information are retrospective. They are historical data, which means the numbers of costs listed here were the cost of goods have been produced. When the manager wants to know some question, like how much a price cut will increase profit, as with Pepsi, this table could not answer how much the cost boosting induced by the additional sales. This is not saying that these pieces of information are useless. It is important index while, say, investors want to know the performance of the company, but it's not a good reference for decision making. How a firm's total cost would change if it increased production above the previous year's level. It can be answered by the firm's total cost function. A total cost function represents the relationship between total cost and the total amount of output it produces in a given period of time. As in figure P1, each level of output the firm might produce assigns a unique level of total cost. Is it true that each level of output associates with one and only one level of total cost? The answer is yes, it is. In economics, a cost function is defined by the value function of the cost minimization problem. A cost minimization problem is a mathematical model that firms choose at the minimized expense of inputs, say labor and capital, to produce a given amount of output with its technology of production, the production function. By the solving technique of mathematical programming, one can find the optimal choice of labor and capital. Then we can have the total cost function by substituting the optimal solution of input into the cost identity, W times L plus R times K, wage times labor plus the rent times capital. In this process, the definition of total cost function is an efficient relationship between total cost and the quantity sold, which means we assume that the firm produces in the most efficient manner possible given its current technological capacities. The only way to increase output Q is to increase at least one of the inputs and thus increase the total cost. Of course, the firm does not always produce at the theoretical efficient level. The firm is assumed that it always tries to produce at the efficient level under its understanding of the technology. Recall table P2. The cost can be divided by two categories. Fixed cost like general and administration expenses, insurance, depreciation, will remain constant as output change. Variable cost like direct labor and the cost of materials will increase as output increased. Note that 1. The line dividing fixed and variable cost is often fuzzy. Some costs, such as maintenance or advertising and promotion expenses, may have both fixed and variable components. 2. When we say that a cost is fixed, we mean that it is invariant to the firm's output. 3. Whether costs are fixed or variable depends on the time period in which decisions regarding output are contemplated. In general, the labor cost is variable for a year-long consideration, but the labor cost for a week is fixed, since the workers are hired for a contract time, for example. We will discuss it when we consider the short-run cost and the long-run cost. To analyze the total cost and the technology the firm uses, we introduce two more definitions of cost function: the average cost and the marginal cost function. The average cost is the per unit cost associated with its output, which is defined by AC of Q equals TC of Q divided by Q, when the total cost function is proportional to output. The average cost function is a constant, C. However, the average cost often vary with output. There are three shapes of average cost function. When average cost decreases as output increases, there are economies of scale. The average cost function is downward sloping. When average cost increases as output increases, there are diseconomies of scale. The average cost function is upward sloping. When average cost equals constant, the firm have constant return to scale. The average cost function is a horizontal line. A firm may exhibit economies of scale, constant return, and diseconomy of scale in different levels of output. Furthermore, suppose Q prime is the smallest level of output at which economies of scale are exhausted and is thus known as the minimum efficient scale. Firms may try to produce at least minimum efficient scale in theory. Marginal cost is the rate of change of total cost with respect to output. It is defined as MC of Q equals change of TC of Q divided by change of Q. Marginal cost can be thought of as the incremental cost of producing exactly one more unit of output. It is practical usage that AC of Q equal to MC of Q equals C. The average cost equals marginal cost equals to a constant, since it is difficult to estimate the marginal cost. This requires an assumption of constant return to scale. Furthermore, marginal cost often depends on the total volume of output. Let's take a look at figure P4. At low levels of output, such as Q prime, increasing output by 1 unit does not change total cost much, as reflected by the low marginal cost. At a higher level of output, such as Q double prime, a 1 unit increase in output has a great impact on total cost, and the corresponding marginal cost is higher. When average cost does not equal to marginal cost. A more general result can be observed in figure P5. When AC decreases, marginal cost is lower than average cost. When AC increases, marginal cost is higher than average cost. When AC is constant, marginal cost equals average cost. We can verify this result by calculus. We write the marginal cost as the derivative of total cost respect to output. When AC decreases, the slope of average cost is negative, which means the derivative of average cost is smaller than 0. We can calculate the derivative of average cost is marginal cost minus average cost divided by output level. Since we consider the positive output only, the negative sloping of average cost implies marginal cost is lower than average cost. Other similar results can be found for other cases. The intuition of this result is easy. Consider the case of average height of our class. If Yao Ming is our new classmate, he is taller than all of us, and thus his height, the marginal height, is larger than the average height. Furthermore, the average height will increase due to Yao Ming's participates into our class. So we can observe that average height increases as the marginal height is larger than average height. Same intuition could be built in the case of lower marginal height and the same marginal height. Now, suppose a firm whose production can take place in a facility that comes in 3 different sizes: small, medium, and large size. For each plant size, there is an associated short-run average cost function, denoted by SAC. According to different subscripts, SACS is the average cost function with small-size plant. SACM is the average cost function with medium-sized plant. SACL is the average cost function with large-sized plant. Due to the efficient production, large amounts of output will be more efficient, or less cost, in a large factory than in small one. In the short run, the plant size is given. For output Q1, a small plant has lower cost than a large plant. Before the plant size are determined, to build a plant is more efficient way than to build a large plant for production output Q1. Similarly, a medium plant is more efficient than large and small plants for producing Q2. As a result, the long-run cost function is the lower envelope of the short-run average cost function, as the bold curve indicated. Some cost is avoidable, but others are not. We can code this cost the sunk cost. It is different with fixed cost. The importance of sunk cost can be illustrated by the following example. While established American steel firms are unwilling to invest continuous casting technology, even as new Japanese firms building greenfield facilities did adopt the new technology. The new technology had higher fixed cost but lower variable operating cost. Established American firms viewed the fixed cost of their old technologies as sunk. Thus, they compared the saving in operation costs against the fixed cost of the new technology buildings. The Japanese firms, in contrast, compared the saving in operating cost against the difference between the fixed cost of new and old technologies. American firms thus required a larger cost saving than the Japanese firms to induce them to adopt the new technology. As a conclusion remark of our discussion of cost, economic cost always refers to opportunity cost. Thus, economic profit is different from accounting profit by considering the opportunity cost, such as the owner's self-employed salaries.